Welcome back to Chapter 13 of Risk and Insurance. I'll be your host, Dr. E. So we'll start the clip 2 for Chapter 13 of Risk and Insurance by looking at the rate of return, determining the rate of return that you earn on your accumulation value. And this is important. So you pay a premium. That is a cost. You receive a dividend. That reduces your cost. You also earn a growth in your accumulation value. The growth of your accumulation value comes from two sources. One is how much of the premium the insurance company directs into the accumulation value, and how much of your premium that they direct into the insurance company revenue. Okay? Then the insurance company will give you a credited interest rate on your accumulation value. And that is what we're trying to ascertain. How much is the insurance company giving you? And they will give you in the contract a guaranteed minimum rate, okay? But also the potential for a higher credited rate. So what you want to see is how much you're earning on that accumulation value so that you can determine if it's a good rate of return competitively. You can compare what you're earning on your accumulation value with Company A and talk to Company B and see what they are providing in the way of a return. And also you can look at investments, alternative investments, to see if you could do better by buying term life instead of whole life that has the accumulation value, and buying investments directly and earning a rate of return on those investments. What your objective is to have an insurance policy that has a good death benefit, but also, if you're using it as an investment vehicle, to be able to earn a rate of return. And of course, you have to take taxes into consideration, because if you buy term, and let's say you buy $1 million term policy, it costs you $1,000 a year. Let's say you buy, and let's say it's a 20-year policy. Let's say you buy a whole life policy, $1 million whole life policy for 20 years, and you pay in $4,000 a year as your premium. The difference between $1,000 and $4,000 is $3,000. Okay? And let's say that is the difference that goes into accumulation value. Well, the accumulation value grows tax-free, tax-deferred, I must say. Okay? When you pull it out, no, it's tax-free. When you pull it out, I'll have to look at that because you may have to pay taxes. I bet you have to pay taxes on your earnings. That's an important item that I'll have to look up. I'll have an answer for you there. Anyway, if you are earning primarily, let's say you invested in bonds in an investment account, then you have to pay taxes on the interest that you earn unless you buy municipal bonds, and that's going to reduce your return. So you have to be careful when you're doing your analysis, comparing taxes between an investment account that's taxable and an insurance account that is not taxable. Now, if you put the money into an IRA, then you don't pay taxes. So you might take that $3,000 difference and put it into an IRA if you're qualified to put it into an IRA. That gets us into a completely separate chapter. All right. Rate of return, that's a long-winded way of saying, let's look at the rate of return. All right, the annual rate of return earned on the savings component is an important consideration if you intend to invest over a long period of time, which most people do with their whole life policy, usually 20 or 30 years. They have this thing called the Linton yield. And the reason I include it is because it's on the exams, the licensing exams. The reason I don't like it is nobody uses it, okay? Because the information that you need to compute the Linton yield is not readily available. So why do they even bother showing it to us? It's on the licensing exams. All right, so this is the average annual return, rate of return, on a cash value policy, whole life or universal, if it is held for a specified number of years. First thing you have to do is separate the cost of insurance from the amount deposited as savings. So that information needs to be available to you. The rate of return is that rate that grows the savings deposits, okay, that have been identified, to the guaranteed cash value at each specified time period. Okay? So we're looking at the premium. We are carving up the premium into two pieces. One is the cost of the death benefit. The other is the amount that is deposited into the accumulation account. And then we compare that with the cash value, the guaranteed cash value, at the end of each period. And the difference between what goes in, let's say you have $1,000, let's say you have a $4,000 premium. Let's say $1,000 is cut out, and $3,000, and that $1,000 goes to the insurance company. $3,000 goes into your accumulation account, and your accumulation account at the end of the first year is worth $3,300. Okay? What does that mean? It means you put in $3,000 and you earned a 10% return on that $3,000. That's what it means. Okay? But you have to have access to that information, and so this method isn't used very often. The Linton yield. The only reason I mention it is because you're going to see it on the test, and you're going to see it on licensing exams. And again, this studies show that the rate of return that is earned on various policies varies widely across insurance companies. That means that different insurance companies will credit you a different rate, something you need to shop around. Studies also show that all returns on whole life policies are negative in the early years, the first 2 or 3 years. Why? Because of commissions. All right. Whoops. Here we go. All right. So we have this thing called the yearly rate of return formula. Let's look at it because you're going to have an example to work, and you're going to have an example on the test. Okay, so the return is equal to the cash value at the end of the year plus the dividend plus the cost of insurance per thousand of death benefit, per $1,000 of death benefit, times the death benefit. This is a long formula, and write it down. I will allow you to bring it into the exam, okay? And once I give you the numbers for each of these variables, it's easy to do. Times the death benefit minus the cash value at the end of the year, whoops, times 0.001, and you divide all of this by the premium, the annual premium, plus the cash value at the beginning of the year. What are you trying to do? You're trying to do basically the Linton yield. You are trying to identify the rate of return that is earned on your accumulation value. All right, let's look. Let's look at this. Okay. Example. Mark purchased a policy at age 35. He is now 42, so 7 years have gone by. Okay. He wants to know what the yearly rate of return will be in year 8. Okay. So the annual premium is $1,500, and the death benefit on the policy is $100,000. Okay. The annual dividend is $400. The cost of insurance is $4 per $1,000 of death benefit. And we saw the annual cost of all the long list of companies, and we said $2.40 looked pretty good, and $4 and higher looked pretty bad, and there was one that was pretty low. Okay? The cash value of the policy was $7,800 at the end of the 7th year. Okay? So Mark got an annual report from his company, his insurance company, that said the cash value is worth $7,800. Now Mark is going to pay in $1,500 in year 8. He's going to get back $400. He's got a death benefit of $100,000, and he's paying $4 per $1,000 of death benefit. So let's plug it in to the formula. So, and he finds out at the end of year 8 that his cash value is now $9,200. So it appears that it went from $7,800 to $9,200, which is $1,400. Okay? How did that happen? Okay, what return did he earn? Okay, so according to our formula, this is the cash value at the end of the year, plus the dividend that was paid. This is why you got to have that formula handy. Okay, plus the cost per thousand. Whoops, there it is. Cost per thousand times the death benefit minus the cash value at the end of the year. Okay, and multiply all of this by 0.001. Okay, to get a sum up here. Okay, and then you're going to divide that by the premium plus the cash value at the beginning of the year. So get out your calculators and start tapping. So this is $9,600 here, and then you're going to say 100,000 minus 9,200 times $4 times 0.001, and add that to 9,600, and then divide that by $9,300. Okay? And that gives you your rate of return, which is 7.1%. 7.1%. Okay? It would say 1.071, but then you have to subtract out 1, and you get 7.1%. And that is the rate of return that you earn in year 8. So what do you have to do? Compare that to the kind of return, which that's a good return, by the way. That's a really nice return. In today's environment, your credited, your guaranteed minimum is probably around 1.5%, I would think, 1.5%. So this is a really high rate of return, but this was done, this analysis was done about 7 years ago when interest rates were a whole lot higher. Okay, let's talk about taxation of life insurance. So life insurance proceeds paid in a lump sum, so this is the death benefit, okay, to a beneficiary are generally received income tax free. So the beneficiary, there's a life policy, it's $1 million, you receive $1 million, you do not pay taxes on that $1 million. Okay? The interest component of any payment is taxable as ordinary income. So what does that mean? Okay? This means that if you decide to take, instead of getting a lump sum from your insurance company, you decide to receive payments over time. What the insurance company will do is they will keep the lump sum at the insurance company. They will invest it. Any earnings on the lump sum death benefit that is paid out, the earnings portion of it is taxable as income. But let's say it's $1 million death benefit, and let's say you decide to take it as an annuity, and let's say you get your first payment and it's $10,000, and let's say $9,500 of that is part of the $1 million death benefit. It is not taxable. 500 of it is earnings, and that is taxable. That's what that's saying. All right, when you write a premium check, okay, they are generally not tax deductible. Okay, so you cannot deduct your insurance premiums. Dividends are not taxable, but interest on any dividends that are retained is taxable. If your interest, if your dividends, if you decide to accumulate them at interest at the insurance company, anything the insurance company pays you back that is earned on the dividends they keep is taxable. So the insurance company will provide you with a report at the end of the year telling you what your taxable portion is and what your non-taxable portion is. Okay? If a policy is surrendered for cash value, any gain, and that's what we were talking about, on the surrender value is taxable. Okay? Your cost basis on the accumulation value is that portion of the premium that goes into the accumulation value, and you do not pay taxes on that. Okay? Because you've already paid taxes on it. When? Okay. You get your paycheck and you spend part of your paycheck on a life insurance policy. Well, your paycheck, the money you get, is after taxes. So the money that you spend on that insurance policy has already been taxed. That's why the death benefit is not taxed, because it's already been taxed. Okay? But once you put your money into the cash value, if you surrender the policy, okay, then anything in the cash value that is higher than what you paid in, those are earnings, the credited interest, and that is taxable when you surrender the policy. Again, the insurance company will provide you a report that says you paid in $7,000 and you took out as a surrender value $11,000. So you're not taxed on the first $7,000, but the next $4,000 is what was earned on the $7,000 over 20 years. That is taxable. Okay? So the gain is the surrender value minus total premiums minus dividends. Because remember, this is what you put in and this is what you get back. So your basis is your premiums less your dividends. Okay? So the gain, the taxable amount, is your total surrender value minus this. Okay? All right. We talked about this earlier, chapter 12, I think. Proceeds from a life insurance policy are included in the gross estate of the insured for federal tax purposes if, okay, the insured has any ownership interest in the policy. So if I take a policy out on myself, okay, and the estate is my beneficiary, then the proceeds that are the death benefit that is paid to the estate is going to be included for estate taxes, not for income taxes. Okay? So those are the two things. So this is where a tax attorney can really help you, because you do not want to pay taxes on anything. If you can avoid, if you can legally avoid paying taxes, you should. Remember that. All right. The proceeds may be removed from the gross estate if the policy owner makes an assignment of the policy to someone else. So let's say that you want to give money to a charity, then you as the owner should make an absolute assignment to that charity. Okay? And that will keep the death benefit out of the estate. In other words, you do not want the estate to receive the death benefit and then have the estate pay money to a charity. You want to exclude as much from the estate as you possibly can. Okay? And you have to make the assignment as early as possible. So in order to avoid having the death benefit included in the estate for estate tax purposes, then you have to make the assignment 3 years before death. This is to keep people from playing games. All right. So the estate tax is payable if the decedent's estate exceeds certain limits, and this changes all the time. Okay. The basic estate tax exclusion right now is $5.5 million per person. So for a couple, it's $11 million. Okay. So first, you're going to calculate the tax, and the tax is then reduced or eliminated by what's called the unified credit, which is the exclusion. All right, so let's look at this. Okay. So the gross estate. So first, you start by including the fair market value of all the assets you own. So everything that you own is appraised. Okay. 1/2 of the fair market value of the assets owned with your spouse, and any life insurance benefits in which you have ownership are included. Okay. And then the gross estate is reduced by certain deductions. So this is a basic walkthrough of how estate taxes are determined. So you start with the gross estate. This is everything you own, and then 1/2 of everything you own with your spouse. Once again, you talk with a tax attorney. If you're going to make investments, you have investment accounts. How should they be titled? Should they be in your name? Should they be in your name and your wife's name? Okay? Or your husband's name? You have to talk to the tax attorney who will tell you the best way to title the ownership of all your assets, your house, a second house, investment properties. Okay? So then you have certain deductions. Okay? Keep this in mind. The entire estate is often passed directly to a surviving spouse, and no estate taxes are paid. Okay? This is called the marital deduction. All right? Other deductions from the estate include mortgages, any costs that are paid to a trustee or an executor, okay, and any funeral or medical expenses that are paid. All right, so here's an example. So we have a gross estate that's worth $8.5 million. So you have a couple, and they have a gross estate worth $8.5 million. Okay, you got a mortgage of $300,000. You got administrative costs of $50,000. You have funeral expenses of $30,000. Those are deducted. That's $380,000. And so you have a gross estate of $8.12 million. Okay. Then you take out a marital deduction of $3 million. Okay. And I'm not sure. I'll have to look up to see where that $3 million, what that marital deduction is now. Okay. Anyway, so you subtract the marital deduction and you get your taxable estate.